welcome to Market Outlook this week. This is Jeff Bish, president of MarketGauge.com, filling in for Keith. Please remember to sign up to receive this on a regular basis if you have just stumbled on it. You can do that probably on the page on which you're looking at, or you can check it out on the YouTube channel as well. Now, I think that there's a real focus that needs to be made in this week's video. As I said last week, I like to try and include a different perspective as part of the outlook, as one little piece of it, and I've got an interesting chart to show you today as well. But the core question for this week really, I think, is what is probably on most people's minds, what's on the screen right now, which is, does the S&P hold the 50 moving average, 50-day moving average? All right, so the magenta line you see in this chart is the 50-day moving average. We're looking at the SPYs, representative of the S&P 500. And as you all know, I assume, we gapped down on Thursday pretty nicely and just continued lower, and then Friday kind of settled in around the 50-day moving average. So do we hold? Well, there's 3 or 4 things that I would want to look at to figure out whether or not this is just a quick blip down off of a high, or something that could go longer, that could take longer to digest. Certainly, the market is still in a very strong uptrend as measured by the 50-day moving average and its slope, and this black line here is the 200-day. So if you look at those two, we're still in a very strong trend longer term. That said, that doesn't mean we couldn't see another correction along the lines of this, and actually I wouldn't be surprised if we saw a correction down to the 200. We haven't seen one in quite some time. So not having had one in quite some time really isn't a great argument for saying we're going to get there, but the fact remains that this bull market has been pretty long in the tooth from the standpoint of revisiting the 200-day moving average. Let's just take a quick step back, though, to another thing that I pointed out last week, which was the relationship between the SMH and the Qs, because that was one of the things I said last week we'd be looking for, and it happened, and therefore I think it's noteworthy. The point last week, I won't necessarily review the whole point, but the point was that the Qs, as seen on the bottom here, and again the magenta line is the 50, I'll go over it in white, the Qs were really breaking down from the 50 if they broke. Sorry, the SMH looked like it was about ready to break down. It was at an inflection point, I said. And while the SMH had a divergence on a daily basis, as we can see, Qs made a new highs. It was more than just that. It was the fact that if the divergence continued and the SMH traded below its recent swing lows, it would also be below the 50-day moving average. The Qs are still well above the 50-day moving average. The big picture here is that SMH has really lagged relative to the Qs. And so unless the SMH demonstrated that what it was sitting at was support and it was going to rally, which early in the week looked like it was going to be the case. I certainly thought it was the case, but it didn't happen. It gapped down, and the Qs followed the gap down. So now this relationship that I pointed out last week is in play from a bearish point of view. If the SMH turns around, comes back, reclaims its 50, breaks this trend line and moves higher, then I'm wrong. All right, I'm not going to say the SMH is dragging things down, but if the SMH continues to stay weak, or worse, gets weaker, then to me, I think we're really looking at a Qs or NASDAQ that needs more time to sell off. You'll hear me really focus in this video on time to sell off. I don't know, don't even want to predict. I don't even want to try and predict the extent of any sell-off. But my premise, just to kind of fast forward, my premise here is that the market has to have, or the market is set up, I should say, to have a longer correction than just a quick bounce down to the 50 on the SPYs where we are right now. This is the 20 on the Qs. Even if we get down to the 50 by Wednesday, and I don't know if that's going to happen, obviously, but even if we were to come down quickly to the 50 in the Qs, I still think the fact is that the Qs were at 13-year highs just last week. This isn't a 1-week correction. That's my premise. That's my thought. Okay, part of it is based on the relationship with the SMH. Historically, when you've had this big of a divergence in the SMH and the Qs, it's taken longer than a quick week or two for the market to digest it. The extent of that correction on a percentage basis, as I said, I don't have a guess on that. I'll just let the market tell me. Now, why is that important? It's important to me because we've just had a first leg down. I'm also going to propose that it is likely, or we might look out for some kind of a bounce. But I don't think the bounce goes to the new highs, and that's what I mean when I say the market needs more time to digest. We might find a bounce. If we do find a bounce, got to be very cautiously looking at it, or carefully looking at it for the resumption or another test of whatever low we put in before the bounce. So those are my cards on the table. This is why I think it's going to happen. Point number one is the setup in the SMHs. With almost all of my points, and the way I look at the market in general, is I've got a premise. If the premise is proven invalid, then I'm not going to stick to the assumption that the premise made. So in other words, if the Qs turn around, if the SMH turns around, rallies, looks good, I'm wrong on this one, and that one is no longer a reason to look for a further sell-off. So SMH divergence. Now this falls into a category for me, and I'm going to look at 4 categories here to analyze the market. I'm going to look to see whether or not the market's at good support. Has it sold off enough to really reach significant support to have it hold, and even if it's got a mark time, it's going to hold at that support. The next thing I want to look at, or another thing I'm going to look at, is the general health of the market. This is where the SMH comes in. The SMH to me is telling me that the general health of this market is not as strong as the bigger indexes suggest they are. That's what I just explained. Q is at a 13-year high last week. SMH is breaking down the 50 in the same week. That's not a broad, healthy market. Next thing I'm going to look at is whether or not the market's oversold, and I also like to look at the sentiment. So if we put all those things together, that's what's going to give me a sense of whether or not it's a good time to turn and look bullish, or it's time to be cautious. So if I stick with the initial theme here of health, there's another thing now that really indicates a market that is not as healthy as the overall indexes suggest. Now I could do a lot more work on this particular point of view, but I think this is a measure that really makes it stand out. So what we're looking at here is the SPYs again, and I want to point out that the SPYs were at their multi-year highs at the beginning of the month. All right, a couple days off of the beginning of the month. What we're looking at down here is the new 52-week new low list, the count. Now, if you're at, and in fact, at this point, we had more new lows than new highs. Now, it wasn't true in the NASDAQ, but it was true in the NYSE. Now, if you're a week away from a multi-year high, you really shouldn't have more new lows than new highs. That's a warning flag. I would have brought it more to our attention last week, but the NASDAQ didn't have the same situation. Now this week you just can't ignore the fact that the New York went to 400, almost 400. I don't think it hit 400, but almost 400 new lows. And I know we sold off. I know we're down near the 50-day moving average, but we're 2 weeks and uh, I don't know, 4 or 5%, maybe not even, off of a multi-year high. This is not the sign of a market that has a lot of underlying strength. Okay. Now, if let's just look at this. Unfortunately, my TradeStation data for new highs, new lows only goes back, I think, 5 years. But we have to go back 5 years to find a situation where we are this close to a significant high and we have this many new lows. Now remember, what I'm focused on here is, has the market had enough time to digest in a corrective mode to look for a really significant rally back up to new highs? My point here, my premise, is that until the market demonstrates on numerous fronts that it's gotten washed out, any rally is not likely to have the strength that it needs. Okay, so this indicates an incredibly weak market at a high point. If this was happening after a significant decline, I'd be looking at 400 new lows and saying it looks like we might be washed out. But we're not washed out when we haven't even really corrected. We haven't corrected much in terms of time. We haven't corrected much in terms of percentage off the highs. So I put the magenta line here just so we could scan back visually and see if there was any other point when the market was near a high and at this level of new lows. So yeah, we spiked on the new lows here, but at this point we were already breaking the 200. We'd been correcting for literally over a month by the time we got to this level. So you can see it's just painfully obvious. Let's just take a look at something that's close. Here we were, and this looks like flash crash. We're about 2 weeks from the highs, and significant number of new lows at that point, or what it felt like, is 200. It's half of what we had. Sorry, 200, half of what we had just last week. Again, by the time we're reaching these numbers at these points, the market was already in a major bear market. Here's the closest I can find. 2007, November of 2007, and you know what? It's not even that close because it looks close in terms of time. It only looks like about a month, but really we had sold off, rallied, sold off, and we're breaking. So in the last 5 years, which is as far back as I can go in the data, we've never had such a high number of new lows at such a high level. And remember, I'm not talking about high meaning that the SPYs are trading at 170 versus 150 in 2007 or whatever it was. I'm talking about that they're trading at the high end of their trending range. Okay, so relatively speaking, it's had a big move up, but as it's had that big move up, there's been an incredible deterioration of market breadth as measured by new lows. Again, this to me suggests that this isn't a number that's flushed out yet. This is an indication that the rally up really was not as healthy as you would have liked it to be. And in that situation, typically, it takes more of a correction than what we've seen to fix itself. All right, so the next so those are my 2 points that really seem glaring with respect to the overall health of the market. Now, let's take a look at whether or not it's oversold. One of the things we're going to want to look for, it would be natural for the market to hold at the 50-day moving average, which also has some good support, and bounce. And so the bounce, be natural to see a bounce and expect it could easily come back up into this resistance level. So the point of this outlook video is not necessarily to suggest which industries, which stocks to focus on, but if you want to focus on looking for a long opportunity, I'm not saying that there won't be any. We will find them, and actually we have a lot of great setups on the long side in the swing evening watch list and the day trading focus list for Monday. Actually a very exciting list from the long side. Exciting because we're sitting at the 50 and we could get a very quick knee-jerk reaction with a 1 or 2 day pattern based on a couple of factors I'm going to show you in a second, and specifically based on that 50. When it comes back up here, we're going to really be taking another look. So what would make us think, aside from the fact that we're at decent support, now I'm going to say decent support, it's not great support, and if we take a look at the IWM, the Russell, I don't even think it's at support yet. This is where I'd be looking for the support. I know the 50 is right there, so really I'll take the 50 down to 100. That's where I would call good support. So in my opinion, IWM still has some really easy downside in front of it. So whether or not it stops ahead of the 50 or comes down to this good support, I don't know. But we might see a bounce. Your support at this point is mediocre. Now, if we go into the market breadth, let me pull in some of these other indicators here. Let me get this page right. Okay, so one of the indicators that could be indicating that it's gone off far enough to at least get a quick bounce is the VIX. If you remember last week I said we want to watch out for the fact that the VIX touched down at a low and now is back over or looking to cross over that 20 period midpoint, and we wanted to watch out for a trend higher. That would indicate increasing fear, would indicate that the market could continue to move lower based on that fear. Well, the other side of that coin is that when you get to the top end of the Bollinger Band, if you reverse and come back in it, it might have been enough for the quick pop to the downside. It does not suggest, however, this is not a huge spike in volatility that would indicate to me that that's it, we've wrung out. Again, it's just enough fear to suggest that maybe a pop for a day or two. I wouldn't hang my hat on it, and I'd really be more focused on whether or not it continues higher. That said, if the market moves higher and the volatility pulls in, again, could pop back up. This is one indication of slightly oversold. It would be more interesting to me, however, were it not for the other factors, meaning the deterioration of the health of the market underneath, that make me believe that we'll probably need more of a volatility spike to flush out this very weakening market. All right, so eye on the volatility. If the volatility really comes in, maybe nobody's worried. Maybe it was enough of a flush. It's still not going to convince me. This was not enough of a pop to convince me that we flushed this market out well enough to go up to the highs, because underlying this market, the underlying structure of the market is too weak. So watch for the VIX, again, to continue to trend higher. That's negative. It's negative until we get a real spike. What's that spike? Probably 18 level or higher. And if it pulls in, then look for the market to be taking a breather to the upside based on the support, and also based on a few other factors that are getting into the oversold level. Here's the McClellan oscillator. All right, so McClellan is getting down near oversold levels. I, however, would feel a lot more confident about the oversold reading being really oversold if we were to get down near the 300 level. That's a level that's harder to reach. So if we got down there, I'd be more confident in the oversold. That said, if it turns back up and the market shows us a good pattern, I wouldn't argue with it. It is pretty oversold. All right, pretty oversold. I just think we need to get more oversold, which I feel like I'm saying over and over again, but that is the premise of the video. Finally, another indicator I like to look at, and last week almost used this indicator to point out that as the market was going higher, the deterioration was evident. That said, it got to a point, however, that the deterioration could have moved higher, and I really believe that had Cisco not come out with such disappointing earnings and Walmart not come out with disappointing earnings, I think that the tone of the market was such that it could have moved higher had the earnings been slightly different. That said, it was falling apart. The market was getting weaker underneath, and clearly when it broke down, that was evident. All right, but this also is getting to a level where if it turns higher and the market turns higher, it needs a breather. It's indicating the market could use a breather to the upside. All right, so those are two, or I should say three, VIX maybe, McClellan kind of, and the 10-day kind of, at positions where it could justify a bounce. Price action is everything at this point. All right, I'm never going to take a position just based on the overall perception I have through the indicators. So we'll need a good positive pattern. Right now we don't have it. We're just sitting on support. So we're a little oversold. The health of the market's weak. We're sitting at support. From a sentiment point of view, I don't have the numbers to pull up on a chart, but I look at the AAII numbers, and they're just not indicating that the market is, or the investor is all that concerned. So these are blunt instruments, or the blunt measure, the AAII sentiment survey. And so I use it as such. If it doesn't get really wrung out for a couple of weeks, I'm not going to lean on it. It's not really wrung out. Wrung out means overly bearish. It's just not that bearish. So now the last kind of interesting chart, and I don't claim to be a cycle specialist, but I do believe that the markets often will trade in a very cyclical and rhythmic way. So IWMs, I think, are the index to watch for the broader measure of the market, simply because IWMs have 2,000 stocks that they represent. S&Ps only have 500. The Qs only have 100. So I asked this question when I went to do this. I looked at the high from the 2011. So that was really the most significant high in this bull move, and I marked that high. I then looked at the next most significant high, and I marked that move. That's how I started this cycle, and so what I did is I fit these two. Now the only reason I didn't fit it with one big move is because I noticed that if I made it two moves, This one could be interpreted one of two ways. One, it was that the cyclical high here was a little early, or due to the nature of this big move, it was still a cyclically important point. Call that fuzzy, call it curve fitting, call it whatever you want if you're a skeptic. If you look going forward, however, you can't argue with the fact that the next cycle high was spot on for a major correction, right? Major corrections is all I'm concerned with. The next cycle was a little early, but it was again a major correction. And the next one was this week, was the week prior. Okay, so it was a little late. Now, the only reason I didn't bring this up last week is really because I wanted to see how it panned out this week, and my feeling was that I had enough information to say if the SMHs break down, do not expect the market's going to come right back. Back of my mind is also looking at this, saying if this starts to break down, the timing is pretty good. Now, I've got this all scrunched up because when I say timing, I'm talking about corrections, and I don't even need to suggest we're going to have a correction that looks like this, but the next correction from a high after a significant move was a significant correction. This was a significant correction. This was the most significant correction we had had since this high, and now this is lining up just all too well to be ignored. Like I said, I'm not suggesting I'm an expert in cycles, but when something is this just blatantly obvious to me, it suggests this to me. The correction that we're in the middle of probably needs more time to digest. There may be a bounce higher. There will be plenty of plays on the long side. Just be cautious, very cautious. And if the market starts heading lower, that's where you really need to be cautious. So I hope that helps. I hope you found it interesting, and I look forward to seeing you in the next video.